I've got a gold chart that goes back to 1883. The first $1,000 to make it took 120 years. It was 2008 that we got the first time we crossed $1,000. So that was 120 years. The time duration to the next $1,000 was 12 years. So you went from 2008 to 2020. I think you'd agree that's quite a reduced rate of time for the same movement in dollars. Then the next 1,000 from 2020 to the point where we ran 3,000 was 5 years. So it was 2020 was that high, and we did 3,000 this year, mid-year. Then the next 1,000 where we actually ran 4,000 was under 6 months. So you've gone 120, 12, 5, 0.5. Now, if anybody understands what a parabola is, when you non-log a chart, and I'll show this visually in a minute, but it is when you're achieving a linear chart is 1 unit of time, 1 unit of climb. That's a 45-degree angle, and it's quite linear. And if you do another unit of time and you do another unit of climb, you end up with a 45-degree line. If you are doing 120 years to get 1,000, and then you are doing 12 to get your next 1,000, and 5, and then 0.5, what you're actually getting is ever reducing time frame, yet the climb rate is ever higher. That's the definition of a parabola. Many people are not quite clear what a parabola is. It's an exponential move. It's not to a multiple like 1x climb, 1 for 1. It's actually each time it's more juice for less time. And that's an exponent. It's like when you cube a number, 1 cube, 2 cube, 3 cube. By the time you get to 4 cube, it starts to be quite a big number that's coming out. And that's where we are on gold. So what tends to happen is when you're getting more parabolic, there's a lot of people that are recognizing it's parabolic and just can't afford not to be in. So they just chase and hit the stack. All sense of pricing and value, it's just about get me gold, get me silver. That happens, when that happens, typically you have an order stack and a bid stack. And normally it's proliferated with depth with levels that people are prepared to get in. When you get price advances that accelerate too fast, you get a bit of a thinning of the bid and order stack because it's moved too dynamically. And what that means is it starts to overshoot. And then eventually you get to a point where some people will say, well, it's a bit much in such a short time frame, could have a pullback. The sellers start to sell, and the bid stack hasn't built up, so there's less volume, so they push it further down. It's just the introduction of volatility. What happens is people's need to get used to an entirely new level and standard for gold price and fiat debasement, because it's actually restricted by our paradigm of ability to understand where it should be. And when you talk about the metals markets, they actually went down during the financialization of everything years. The financialization of everything years was from the Volcker period where he super spiked rates. He killed the gold bull at the time and resaved the debt markets and pushed rates so high. He made bonds so cheap that they actually became potentially quite valuable. And then we had the 40-year bond cycle. During that period, gold, there was still inflation. There was still an expansion in monetary supply. Gold should have been doing a linear increase according to the M2. And in fact, the M2 itself started to be more of a parabola, but gold actually went down from its 800s, well down until it hit the lows around 200s in 99, going 2000. Just as we were having one of our first major bubbles, being the .com. And that was basically the bottom of gold. It started to move up, but everything else was still moving up faster. So what's actually happened is we're getting a parabola now for all the back pay we're owed for when gold should have been doing what the M2 was doing. and actually was going in the opposite direction. So it was suppressed, it was ignored. Everyone goes, why do you want to hold that? It doesn't pay any interest. You dig a hole in the ground, you get it out, and you put it in some other hole in the ground. All the Warren Buffettisms, all the various things. It's the culture. It's the epoch of stocks. The end of the bond rates high of 1880 brought in the epoch of stocks and, to a degree, bonds. It was a bond bull, but the stock bull was even bigger. This was the Warren Buffett era. We all went from 1980 to finding out his name in the mid-80s to 90s. We followed him and he just became billionaire plus. You've got to invest for your epoch, and Buffett went long stocks that were cash flow generative. He wasn't particularly genius. He never bought fluff. I mean, in terms of patience, he was a genius. I don't want to strip him of anything, but he invested for his epoch, and the epoch ended with the bond turn. It does point to an inter-rejection. You can see, for example, that was a violent one, a more violent one, and it did lead to further downside. This is actually, by log scale, not particularly violent, and we said the pullback will be less and not as deep. And this is the next big move. This is the primary move. This is your most exciting move coming. And it's you once you've hit 3 times, you have to wait for that dip to do it. So we did predict that. I mean, we also appeared with Mario, and he was saying, no, I think it just rips straight from here. And we were saying, no, I think despite it looking super strong right now, that was while this was happening, and you were up at the 54s, we still think you get that rejection. And it came a little later, but there's a little bit of an inflationary tilt to this. This high is tiny bit higher than that one as well. You've got to remember there's a certain time period between each of these, and again, the fiat debasement. But so if we do our HVF method draw, which is something that we're unique, we'll recap the silver targets with you. I just have to make one adjustment for this slightly higher high on the second one. It's so close, and we make it just a minor imperfection, 49.81428. That is the high there, and we say leave that one out, and this is what you get. So here's our setup. Now, HVF method is our unique trading methodology, and it got us long this trade well before the cup and handle guys were in here. For them, it was only interesting once we got to the $50 mark, or the $45, $50 mark. For us, you broke over here, and that was still in the 30s. And your stop loss is there, and this has made what we call our first interim target. And typically after running that line, you'll see it there at $40, 40.92. So once you've run 41, you typically get at some point some degree of pullback. Now, how far does the pullback go? Our worst case scenario would be a revisit to our green line there. It doesn't have to do that, but sometimes it can happen. It's called a return move to the triggering event here. That would bring you right down to the 30s. I don't feel that. This rejection is nothing like the scale of that shooting star rejection. So I think you get a little bit lower.